That environment made traditional portfolios work. Stocks produced growth, bonds provided yield and stability, and both often worked together. But now that cycle has reversed. Yields have risen, which means bond prices fall. And that is not theoretical. Moss points to the banking system holding large unrealized losses on Treasury portfolios because those bonds have declined as rates climbed. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Guys that love to hear about Bitcoin versus gold, you might be interested in a debate I just recently did with Peter Schiff on Zero Hedge, where we went at it for about an hour talking about Bitcoin versus gold. Of course, I won, but we'll link to that down below if you want to check that out. But let's talk about something different, and this is much bigger than Bitcoin replacing gold. All right, we're going to talk about, first of all, the deal that broke. You have to understand what the markets are, the purpose, the intention of those things, sort of at a first principles level, so you can start to understand why things might need to change, how they might change, and then why a potential solution could be a good one. Okay, let's take a look at that. So the deal broke. So what deal am I talking about? I'm talking about the 40-year deal. For the last 40 years, we've seen one constant, and that is that bonds have continued to go down. Bonds are debt, right? So you loan money to the government, they issue a bond, and they pay you yield on that. So we can see from 1980 at a peak right here of about 14%, the price of bonds has continued to go down, and it hit this crazy world where like they paid zero. In some nations they paid less than zero, meaning when you gave them money, when you loaned the government money, you were guaranteed to lose. Crazy, right? But it got all the way down to zero, and now it's been returning. And the problem is that for the last 40 years, everybody who's been investing has been doing, you know, some sort of a stock and bond portfolio, a 60-40 split, something like that. And that was a good deal because the bonds kept becoming worth more and worth more and worth more, and the bonds were going up, up, up. When the yield comes down, the bond goes up. It sort of works in this inverse relationship. But now it started to reverse, which means bonds are losing value. It's part of the reason why right now today banks are sitting on something like $300 billion of losses, because they're holding US Treasuries that are continuing to lose value over and over. And so the deal was for the last 40 years that all you got to do, make money, put some into bonds, you get that fixed income, and everything's going to be good. But now that deal is broken. There's three main reasons why it's breaking and it's never going to come back. Then we'll talk about the replacement and what we can do about all this. But number one, there's three external forces that are really causing a shakeup here. Obviously, right now we have the Iran war that's going on right now, and that's created a lot more inflation. And when we get more inflation in the system, then it, number one, makes the bond yields not near as attractive. But number two, it changes the tools in the toolbox that we have from a monetary perspective that the Fed can do and things like that. And so we can see the monthly change in inflation has been going up. And a lot of this is what we call cost push inflation. So you have demand inflation, you have cost push. Demand is when you print too much money, like in 2020, they sent out the stimmy. Now you have more money chasing a fixed supply of goods. But in this case, cost push, meaning the cost of oil went up. And so when the cost of oil goes up, then everything goes up on top of that. And there's really nothing the Fed can do to prevent that, except for try to destroy demand. Meaning make you broker, make you not be able to afford more gas, and you buy less. That's all they can do. It's terrible. Okay, the second force that I see going on is too much supply and not enough buyers. What do I mean by that? There's too much supply. There's too much debt. There's too many US Treasuries being sold, and there's not enough buyers that want to buy the debt. The United States government continues to run $2 trillion deficits. Right now, the deficit is on track to be blown out again. Obviously, with the war, it's very expensive. And so the US Treasury Department must sell massive amounts of bonds. They have to sell more bonds, more bonds, more bonds. But at some point, there's not enough buyers. It's always about supply and demand. You can boil all of economics, all of investing down to supply and demand. It's that simple. Okay. Well, there's a million reasons why supply and demand, but it's always that. So we can see in the year 2026 projected to be 1.9 trillion. That is the deficit, not quite 2 trillion, 1.9 trillion. But of course, that's going up rapidly. I'll show you a chart in a second. The market is demanding higher yields. So in order to get more buyers to come in, we have to offer them higher yields. We have to make it more attractive for them. Okay, that's a problem. And then we have, because why is that a problem? Because as we start having higher yields, it makes bonds lose more money, right? It's a bad deal. It's an inverse correlation. It's a terrible way that the market is built this way. I'm gonna show you how we're fixing that. Okay, the third one real quickly is that foreign investors are selling. So not only are not enough people, there's not enough buyers for the amount of debt that we need. On top of that, buyers are actually getting out of the market. They're selling. We can see that the assumption broke. We can see total holdings dropped from 29 billion down to 19 billion for the German and Dutch markets. So they're actively selling. So they're not just not coming to buy, they're actually selling what they have, which means there's even more volume being dumped into the market. We saw Japan's 10-year treasuries, which used to provide negative yields, are now delivering one of the highest yields since 1999. So the yields are going up. So there's three structural reasons, three underlying forces that are causing this. And again, these are sort of moving targets, right? So we can see right here, this is the deficit blowout scenarios that the Iran war could have an impact. Now, we don't know how long it's going to continue going on, nor do we know how much we're going to spend. So these are just some potential scenarios. But if this were to go on, let's say for where we're kind of past the 6 weeks, if this goes for, let's say, up to 4 months, that could put us up to about 2.2 trillion on the deficit instead of 1.9, 2.2. It's pretty big. If this goes on for, let's say, a full year, now we're at 2.56 trillion. Pretty big deal. So this kind of blows out all the numbers. And then we also have to understand this one more piece before we start looking at potential solutions and where we go from here. But we also have this. So when we talk about buyers moving out, we're talking about governments moving out, not buying as much debt, selling the debt. But we also have the retail buyers moving out. So this is the net buyers to net sellers. This is the US boomers from 1980 to 240 to the year 2040. So you can see that we had more and more boomers buying. But now the boomers are getting out of the market. They're getting old, they're retiring, and they want to spend their money before they die. You know the book Die with Zero? They've all read that, and they all want to spend down, and they're not buying either, and that's continue to project all the way down through 2040.
Third, foreign buyers are stepping back or outright selling. He cites evidence of foreign demand weakening, meaning fewer large buyers absorbing U.S. debt issuance. If foreign institutions are reducing Treasury exposure, the market must find new marginal buyers domestically, or yields rise further to clear the market. He adds another demographic layer. U.S. boomers, historically major bond buyers seeking safe income, are now retiring and shifting from accumulation to spending. That means the biggest generation of buyers becomes a net seller over time, worsening demand dynamics through the 2030s.
All right, so that sort of sets up where we're at, but there's a replacement. There's a shift already taking place. What are we talking about? Well, some of the shift that we're seeing are things that you've heard me talk about. I've actually already talked about them just on this video. Let me show you two charts from another video I did, I think last week. Foreign official treasury demand is having a structural collapse. So what I'm talking about, foreign treasuries that hold US treasuries, the demand is collapsing. We can see here from 2015, there's about 34% at the peak. It's down 10 percentage points all the way here to about 24% this year. 10 percentage points in only about a decade have disappeared from demand from other countries. Okay, so that's a pretty big deal. Where are they going? Well, we can see, back to my gold bugs here, we can see that a lot of them are buying gold. So we can see during the same time frame, here was gold buying 2020 and 2021, small step up. But here we have 22, 23, 24. Look how much the increase in gold buying was, and it's only continued. Now, why this year, you might ask? Well, this year, if you can remember, all the way back to 2022 was when Russia and Ukraine got into war, and the United States, NATO, the West decided to freeze Russia's bank accounts, basically seize them. And the whole world realized, shoot, I guess those US treasuries that were supposed to be risk-free aren't so risky, or aren't so risk-free because, shoot, they could just take them whenever they want. So if that can happen to Russia, it can happen to any of us. So we should probably not hold as much US treasuries, and we might hold something like gold in our own safes that they can't steal. And so we've seen that huge demand. So for all these reasons, we're seeing this happening. Okay, but that's just for gold. And that's just for treasuries, and more specifically, it's for specific use cases. But there's something even bigger going on. Let's take a look at this. So this is why I'm saying it's not just a replacement for gold. Let's take a look at financial markets in the world. You see, right now, Bitcoin is right down here. It barely registers on this. And right here is the gold market. So for all my gold bugs out there, they love to see how much bigger gold is than Bitcoin. And as I said in the intro, Bitcoin's not coming to replace gold. As you can see, there's much bigger markets at play here. So when we talk about the couple factors like we talked about, where bonds are going to continue to lose money, they're forced to be liquidated. I'm going to show you what that means in a second. And part of the reason why people buy bonds, as I showed you, like those boomers, is they need fixed income. So the tradable fixed income, securitized fixed income market is about $145 trillion. That's this. Look how much bigger. And then we have here about $350 trillion in debt. So debt is also income. So look at these markets, and this is what we're talking about. If I can't trust a government to hold their debt and then to pay me back, if I can't trust a government to pay me the yield or pay me the yield without debasing me, then what do? So we're not just coming for gold, well, we're coming for something much bigger. Let me show you what we're talking about here. Okay, so the real reasons really come down to the rates. The problem, or the reason why we're seeing rates go up, really twofold. One, as I said, we have to entice more people to buy them. But the bigger problem is something called financial repression. If you've been watching my channel for any period of time, you've seen me talk about this many times. And the reason why I talk about it is because it's literally written as a playbook. When I say that, meaning like the BIS.
Finally, Moss makes a provocative point using risk-adjusted measures. In recent years, U.S. Treasuries, often called the risk-free asset, have shown worse performance characteristics than many people assume. He argues that investors buy debt for safe income, but if the debt loses value, fails to beat inflation, and becomes more volatile than expected, the entire reason to hold it collapses. So the real question becomes, where do investors go to get income without sacrificing purchasing power?
Literally wrote a white paper, the IMF literally wrote a white paper explaining what it is and why we're going to do it. And we've done it in the past. We've done it in history. Okay, what does this white paper say? I'm going to give it to you in a nutshell. Basically, in order for governments to liquidate their debt, get rid of their debt, they need to hold rates low and let inflation run hot. They can steal, they can liquidate, they can pass it on to a tax to their bondholders. All right, so what that means is that even though the government's going to pay you 4% or 5% or whatever percent they're going to pay you, you'll still be losing money because inflation will be hotter than that. So on top of the bond losing value, I'm losing money on my holdings because the yield's going up, the yield is still not keeping up with inflation. I'm losing, so that's financial repression. So why, no matter what they pay me, why would I want to hold that if the amount they're paying me is less than what I'm losing to inflation? That's a problem. All right, you can see the financial repression definition right here in case I didn't explain it properly. It acts as a hidden tax on savers. It's artificially low interest rates. Why? What is the purpose and the impact? The purpose is debt liquidation. You can just get this right from Wikipedia. The purpose is for debt liquidation. And what does it do? It creates a wealth transfer where it transfers resources from private savers to the public sector. That's the purpose, to steal your money and give it back to the government. That's why nobody wants to do it. We want to ignore the white paper. Now, if that wasn't bad enough, most portfolios out there are using a 60-40 bond portfolio or some sort of a percentage like that in order to bring the volatility, or we say bring the risk down. So if equities go down, I have my fixed income and it evens itself out. However, you might be surprised. If we take a look, this is the 5-year Sharpe ratio. A Sharpe ratio is how we measure how volatile an asset is. Now, this is the last 5 years, and I'm comparing the most volatile asset, the one that everyone's afraid of because it's so volatile, Bitcoin. We're going to compare gold, and we're going to look at U.S. Treasuries, the risk-free asset, right? The one that we use to limit volatility, the one that we use to limit risk. And what we can see on the 5-year Sharpe ratio, here's the 0 line. So what we can see is that on a Sharpe ratio basis, the U.S. Treasuries is the highest risk. It's the highest volatility asset you can own. So not only am I losing money because they have to keep raising rates, not only am I guaranteed to lose money because they're going to liquidate me regardless of what the financial repression liquidate me, regardless of what they pay me. On top of that, it's more risky than holding Bitcoin or gold. So that you might ask yourself, well, why would we want to hold it? And now you've answered your own question. So what people need, the reason why they put money into debt is because they need income, safe income with good rates. I need yield. I need income, but I don't want to lose my money. I want to keep my capital, and I want to earn yield, or I want to earn income off of it. Now,
if you found value in this breakdown, Please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.